In this presentation, we will take a look at partnership withdrawals. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We're going to take the withdrawals from this trial balance, the data on the left side, the trial balance on the right side, where we currently have cash and equipment, the assets in green, accounts payable, our liability in orange, capital accounts, including the capital account and the withdrawals, where we will be focusing in on here, and then the income statement accounts, revenue and expenses, resulting in net income of the revenue 10,000 minus expense 3,000. And we have the debits or being non-bracketed, the credits being bracketed. The bracketed numbers minus the non-bracketed numbers gives us 0, meaning the debits equal the credits. So our goal here is to record the withdrawals. And note that the withdrawals don't necessarily have to match the profit sharing. That's the first thing that can be confusing with partnerships. When we look at these capital accounts, we often look at them and say, hey, the balance in the capital accounts and or the draws or the investments should match what the profit sharing is. And that's not the case. Note that the profit sharing is only represented for the profit. So we have, in this case, 3 plus 2 plus 1 profit sharing. So the first partner, that adds up to 6, has 3 over 6. That would be 0.5 or 50%. To the first partner. That's how we'll allocate the income, 50% of this 7,000 going to, in this case, C, but that's not how we're going to allocate the withholdings. The withdrawals are going to be just in alignment to what is in the capital account. So there may be restrictions in the partnership agreement as to how much draws can be taken out in a certain year. They can be very detailed. We have a lot of flexibility in the partnership agreement. But on just a basic level, we know that the draws, these capital accounts represent what are in the capital account or what is owed to the partnership of assets minus liabilities. So that's kind of the value that is owed to each partner of the partnership. So they could draw, in theory, up to the amount that they have in the partnership. Now, again, the partners may put restrictions to that because clearly either partner doesn't want the other partners to pull out all the money from the partnership. If they did, cash would go way down, and we couldn't pay all the partners their entire capital account unless we sold, say, the equipment. And that would take like a liquidation process. But in theory, they can pull out what they want up to basically the capital account. They couldn't make the capital account, or they shouldn't make it go negative, because that would mean that they drew out more than had been invested and allocated to them through the profit sharing, through net income. And that would mean that they would owe the partnership money. So what we're going to do now then is just post these draws. We're going to say that C drew out 2,000, K 1,000, and M 1,500. Again, where do these numbers come from? We made them up, and they don't tie out to the profit sharing here. It's just kind of what each partner decides to do in accordance with the partnership agreement, and should probably consult other partners in terms of how much should be pulled out by each partner, so we can plan for the future to see how much we're going to have in capital. We also could restrict the withdrawals or benefit those who don't withdraw as much by having the income allocation be allocated more to those who have more capital invested in the business. So we're going to say that the withdrawals are going to be here. Now, we typically have a different draws account just as we would for a sole proprietor. So the capital accounts look a little bit more intimidating for a partnership simply because we have more of them. So we have 3 partners rather than 1. For a corporation, we're going to have just retained earnings, and then the draws type thing will be dividends, which will be all even for a corporation, whereas they can be different for a partnership. So we're going to record these draws to a separate withdrawals account rather than posting them to the capital account. And that's typically what we do. We typically have the investments go to the capital account, and the draws then have a separate account. Why? Because the investments, we assume they're only going to happen a few times Hopefully the partners put in an investment at the beginning of the partnership, and then they make money and they draw out money later. So that we expect draws to be a normal part of the business. The business should earn money and give some of that to the owners in the format of draws, so the owners can then take it for personal use. What we don't expect to happen, or we're hoping isn't going to happen, is that the owners keep on putting more money into the partnership. They should be taking money out of the partnership after it generates money for personal use. So that's why we expect the draws to be more of them, and therefore constitute its own account here that we can track the draws as they happen and then close them out in a similar fashion as we do to the income statement accounts at the end of the time period. So to record this, we're just going to say that the withdrawals for C are going to be this 2,000. The withdrawals are going to be debited because it's kind of like a contra asset account or a contra equity account, meaning equity accounts typically have a credit balance. The draws are going to be something that brings down total equity. So we're going to do the opposite thing to it, a debit. Then we're going to credit the cash that's going to be drawn out here for C's draws. And if we post this out, then the draws account is going to go from 0 to 2,000 in the debit direction. The cash from 48,000 down by 2,000 to 46,000. So now we've got the draws account being recorded for C. We're going to do the same thing for K here. So K has 1,000 draws. K's draw is going to go up in the debit direction by that 1,000. The other side of it, then cash is going down. We paid out cash to K as draws. When we record this, we see that the draws is going to go up. So here's draws. It's going up from 0 by 1,000 to 1,000. The cash is going from 46,000 down by 1,000 to 45,000. So if we see all the accounts here, here are all the accounts. Note that these transactions for the draws do not affect the income statement, meaning net income is not affected. And that's kind of one of the key points here. It's a temporary account. Money is leaving the partnership, but it's not for business expenses and therefore shouldn't be part of net income. It should be allocated directly to one partner. Note what would happen if we put it in as an expense. Say we just put it as an expense and it was a personal draw for the partner. Then it would affect the net income would still go down, but then all three partners would be affected in accordance with the profit sharing. Their capital accounts would go down by a proportion of the profit sharing. And what should happen, of course, is that whoever took the draw out should be reducing their capital account by the full amount that was drawn. It also could have tax effects too, which we won't get into here. But if we expensed it, we'd have lower net income and taxes would be less, but improperly so. So we should be putting it up here in draws for that reason as well. And then we've got M's draws as well, which is going to be a debit to the withdrawals and a credit to cash once again. So the withdrawals going from 0. So here's the draws 0 to 1,500 here. And then the cash is going to be starting at 45,000, going down by 1,500 to 43,500. That leaves us then with the 43,500. If we have all the accounts here, we can see that the draws accounts are now matched up to the capital accounts. And again, the capital accounts look very intimidating now, the whole equity section, because we have all the partner accounts, then we have the related draws accounts. All this means is that the C's capital, we basically owe the C of the assets minus the liabilities a $40,000 share of the partnership. Now that'll go up once we allocate the net income here, which is $7,000 to the partners. And then if C took out $2,000. So really we only owe them $48,000. So that's going to be the same for each partner. We're going to say, hey, this is the amount that is owed to them. This is the amount they drew out during this time period, whether it be month or year. And then if we net the two, that's their net capital account as of this point in time. We will close out the draws just like we would in a sole proprietor to the capital accounts. They are temporary accounts. However, they're not part of net income. They're not part of the net income calculation. They're not in the income statement. So the net income calculated as revenue minus expenses gives us the net income. The withdrawals solely reduce the capital accounts for individuals, not for the net income, which will be allocated to all of them, all partners in accordance with their profit sharing agreement. For more accounting information and accounting courses, visit our website at accountinginstruction.info.